Advanced Financial Accounting. In this presentation, we're going to work a consolidation problem in Excel where we have a non-wholly owned subsidiary, no goodwill, and we're going to consolidate them 1 year after the point of consolidation. In other words, we have two companies involved. P and S are going to be our two companies. P purchasing S as of year 0 at the point 0, then 1 year later is going to be the point of consolidation. It wasn't 100% that was purchased, so something under than 100% was purchased, so you have a controlling interest, but not a full 100% interest. There's no goodwill that will be involved in this problem. We're going to be adding levels of complexity here. The new thing that we're going to have here that'll be a little bit different than the problem prior to this is that now we're going to say 1 year has now passed. And so now we're going to have income statement activities as well that will complicate our elimination entry a bit. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We have the information on the left-hand side. We're going to be entering that information into the blue area on the right-hand side, including our journal entry for the elimination or consolidation entry, our consolidation worksheet, and then we'll take a look at the financial statements, consolidated balance sheet, income statement, statement of retained earnings. Back to the information where we have P purchased 90% of S, outstanding common stock. So P is going to be one company, S is going to be the other company, P is going to be the purchasing company, S the subsidiary company. We have a parent-subsidiary relationship at the end of the purchase. However, 100% wasn't purchased. It's a less than fully purchased subsidiary, only 90% being purchased. The purchase is taking place as of the beginning of the year. And then we're going to be doing the consolidation 1 year later, 1 year of activity then exactly having had happened since the point of consolidation. The purchase price at that beginning point, year 0 basically, $279,900. The book value was $311,000. In other words, assets minus liabilities at the point of purchase, $311,000. That's not going to equal the subsidiary's assets minus the liabilities here because we've had a year's worth of data. But if we were to say assets minus liabilities or add up the equity section at the point of consolidation, then the idea being that that would be the book value at that point in time. And the purchase, so that's the 311. P uses equity method to account for S. So P is going to account for S on their separate books using the equity method, which you would expect would be kind of like the normal method considering the controlling interest. And then we're going to have to consolidate and remove the investment, so we need to know what kind of method they use to make it easier to do the reversing or consolidation entry. Equity would typically be the method most often used, you would think. Consolidation worksheet for the year end, that's what we want to put together. Let's take a look at our little worksheet down here first. We have the book value at the purchase time. So when we purchase book value, assets minus liabilities of S, and I always think of we're P, we're the purchaser. So when we purchased S, they had a book value of the $311,000, and 90% of that would be the $279,900. And so I'll probably work one of these problems where I get the perspective of S, right? When they purchased us, they purchased 90%. Now we'll keep it at P. We're in the perspective, we're P here. So we got purchased 90%. That's going to be the $279,900 there. And then the amount that was paid was the $279,900. So once again, that's going to be a bit of a simplification. We're going to be adding complexity to this as we go. But notice, as of the point of purchase, they purchased exactly 90% of the book value, the equity section, assets minus liabilities of the company S. That means there's a non-controlling interest. How much is the non-controlling interest? Well, if we take the value as of the point in purchase and multiply it times the 10% now, the non-controlling interest would be 31,100. So the 279,900 and the 31,100 add up to the 311. So the 311 being the book value as of point 0, the point of purchase. Okay. So then we're going to be putting these two things together. So we have P and S. We're going to get their two trial balances just as we have seen in the past. We're going to line them up. Again, that would be harder in practice than in a practice problem. Not too difficult really, but tedious to do. And we've lined them up here, and now we're just going to add them up. That's the first step of our consolidation. So I'm going to say, all right, let's just add these up then. Why don't we try that? And then I'm going to copy this, and then I'm going to paste it down here. Now notice we have income statement accounts because we do have, this is what's new from just the last one we did. And that means because we have a year's worth of activities, but now we've got a non-controlling interest in this case, so we'll have to deal with those. Added them up, and we're like, we're done. But no, we're not done, because we totally have to eliminate some of this stuff, right? The investment account has to be eliminated, so we have to do our consolidation or eliminating entries. It'll be a little bit more complex now because now we have a non-controlling interest and a year's worth of data. So we could just piece this together one at a time like we did before. Let's just go, all right, well, I know this much. I know this has got to go. This investment, that's got to go. So that's got to go off the books. That, I'm for sure. I'm great. If I'm doing this on a test, I'm picking up some points with that for sure. And then we got to remove the equity side is the other side of that transaction. Now, on the equity side, if it's been a year since the consolidation, the assumption here is that this common stock is on the books at par, let's say, and the retained earnings, the income, would be rolling into basically the retained earnings. So it doesn't seem as though anything would happen to the common stock a year later. So the common stock is probably no other issuance of common stock has taken place. So in other words, that 189, even though it's a year later, probably the same number as of the beginning of the year, we're going to remove the entire thing. Once again, you might say, hey, we only got a 90% interest. Why are we removing the entire thing? Because we're going to remove the entire thing basically at the point of consolidation and then report the non-controlling interest separately down here with this NCI in the NA, with the non-controlling interest and the net assets of S, the other company. So I'm going to say, all right, then let's just take off the whole common stock. So common stock being the same amount as it was when we purchased this thing. And by the way, this should be on the credit side. So why don't I put that on the credit side so it doesn't look funny? Probably annoying people. And I'm not trying to annoy people, although I do it sometimes, totally inadvertently, of course. And then we have the retained earnings. So retained earnings. And once again, this retained earnings, because it's only been 1 year later, this retained earnings is probably the same retained earnings that was there at the beginning of the year, unless anything was posted to it. Because usually the only thing that hits retained earnings is the net income rolls into it. And we haven't done that yet because the net income is down here. The $78,000 is going to roll into the retained earnings. The other thing that may be in retained earnings posted directly to it is the dividends. So in practice, you might see retained earnings and have to pull out the dividends, but we pulled out the dividends for us and put them into a separate account. So nothing has been posted to retained earnings for the time period, the year that has passed since consolidation, and therefore we can remove the entire retained earnings. It's the same number that was there at the point of consolidation. So I'm going to say there goes the 122, and then we're going to say the dividends need to go, and once again we're going to take out the entire dividends here. So the 27,000, we're going to be removing the dividends. So I'm going to say this equals the dividends, and I'm going to be crediting the dividends for the 27,000. So we'll remove the dividends. So at this point in time, we took off the investment, which is our entire investment up here, and then we took out basically the equity section thus far. Now, at this point, let's just consider, just to double check, because we know this investment's at the equity amount, this 325.8, but it might make sense just to kind of think that through. How did that get there? Well, we know that we put the initial investment on the books at the 279.9, because that's the amount that we purchased it for, the 279.9, which happens to be equal to exactly our 90% portion of the book value at the point of purchase, then credited cash. Then this company made $78,000 during this time period, so of income. On the equity method, we'd represent our portion of it, which would be 90% of it. So we took that amount times 90% and increased our investment. The other side recorded here at the 70,200. So this then you would think would need to be removed, right? And then we've got the dividends that went out, the $27,000 dividend. Our portion of that would be the 90%. Under the equity method, we would decrease the investment here and record the cash. So if we add up then the investments, that's going to be how we got to that 325.8. So there's going to be the 325.8. So we removed the 325.8. We removed basically the equity portion here, the equity portion of S, even though we only have basically a 90% interest in that. Then we have the net income down here. So the net income we said was the 78,000. Now we represent our portion of that net income in this account, the income from S. We don't want this account here because we want to represent the income in their respective categories. So we need to remove the income from S. So we know that's got to go. So I'm going to go back up top and say, well, I know that that's got to go too. So I'm just going to say, let's remove the income from S, and we will then debit that because it's a credit down here. So we're going to have to debit that to get rid of it. Okay, so now we're out of, and we're not in balance now because, of course, we deviated from our first more simplified problem where we have a 90% interest or not 100% interest that was purchased. So that results in us now needing to record this non-controlling interest in the net assets here and the non-controlling interest in the net income here. So we're going to say, all right, so now let's record the non-controlling assets in the net income. Let's do that first. I think it's easier to see the non-controlling assets in net income. So I'm going to say, all right, so now I've got to record the non-controlling assets in the net income. And that's basically going to level this one out, right? The 70,200, because this 70,200 representing our portion was only 90% of that number. So now we're going to say, all right, so this one, you would think then, I'm going to say is going to be equal to, and we could say that it's going to be, I'm going to say negative of the net income times the non-controlling interest, or 10%. 10%. So there's the 7,800. That 7,800, if we would add those two up now, add up to the 78,000. So there's the 78,000, which is going to be the net income, the full net income of S. And then once you have all that, you can basically think about this as the plug, right? The non-controlling interest in the net assets. So non-controlling interest in the net assets could be the plug, which would be this negative sum here. So I could say, well, that's going to be the negative sum of these. And that's going to be the 36.2. So if I was to add up the debits, then they add up to the 389. And if we were to add up the credits, they add up to the 389. If we were to subtract them out, they would add up to 0. Now, the other way to see that is if you took, the equity, this is the non-controlling interest in the net assets with the assumptions we have for this problem. If I was to take the total equity, which is all the blue accounts, because income would roll into the equity section. If I was to just add all that up, it adds up to that 362, I think it was. So let's see if make this a little smaller so we could see the screen. We got the 362,000 times 0.1, 10% non-controlling interest. There's the 36.2, right? The 36.2. Or in other words, you could say that it's going to be the assets minus liabilities. Assets minus liabilities equals the equity section. There's that same 362,000. So you can say, all right, there's the 362,000 times the non-controlling interest, 0.1. There's the 36.2. So that's another way you could see that given the conditions we have in this problem. So notice this one could be this eliminating interest starting to get a bit more complex here to kind of work that out, but you can piece it together one by one. And if you understand the equity method that's down here and that, non-controlling interest, you can piece it together. Let's go ahead and post it and see what it looks like. Let's say, all right, so we're going to say the investment, that needs to go away. That's straightforward. If I know nothing else, I know that's got to go away. So let's going to say, all right, that I know is good, right? And then the common stock is going to be down here. So I'm going to remove the entire common stock for S, just like we would before. So we're going to say I'm going to remove the entire thing because then I want to report it back on. So there's the 480, there's the 189, adding up to the 699, removed the 189 to get back to P portion of the 480. We're going to do the same for the retained earnings because this is the first year of operations. Nothing has been posted to retained earnings since the point in time. So we're just going to remove the entire thing here. The 122, so there's the 122, there's P, there's S, there's the total. We removed S, bringing us back down to the P's total. We're going to remove the dividends, the 27 here. We're going to remove the dividends in here. So we're going to say this equals the dividends of the 27,000. So we'll remove those. So there's PS, removing back to just P's dividends. And notice this one's a little bit confusing. You might say, hey, like, why would we do that? Because 10% of the dividends did go out. But notice we're gonna record the equity, the net equity here down into the non-controlling interest. So that's where, we're gonna report the equity. So then we're gonna say, okay, then the income from S, that's straightforward. I know that has to go away. So the income from S, that's got to go away. We can't have income from ourselves. So I'm gonna say that equals the 70,002. So that removes that. And then we've got the non-controlling interest, which you'll see down here acts basically like an expense, because we're kind of looking at this from the perspective of P here. We added the stuff together, and then we're going to say, now we're going to group up the portion of the net income. Instead of doing it line by line, we're going to group it all together and say, here's that 10% portion that's really, we're going to allocate to the non-controlling interest. So it's going to act like a P for the consolidation. It's going to act like an expense for the consolidation process here, which really represents kind of what P has control over. So they're going to say, okay, and here's that one line item that is showing the portion that we're going to allocate to S of the net income. And then we have the non-controlling interest in the net assets, which we're going to represent in the balance sheet. So that's going to be in L15 equals the non-controlling interest here. That's going to be the 36,002. So there we have it. Now there's one other entry we're going to have to enter, and that's the one related to the depreciation and the building and equipment as of the first point in time when the consolidation took place, because we want to have the book value for S at that point in time, which will be a debit to the accumulated depreciation and a credit to building and equipment, as we saw in the past, for the amount that was there at the beginning of the year, which we know if it's at 18,000 at the end of the year and the depreciation expense was 9,000, the difference between the two must have been the beginning balance here, which was 9,000. That's going to be that transaction. Now, we're going to move forward and actually create the financial statements, and then I'll go back in and make that one transaction, which will adjust these accounts on the financials. Hopefully that's not too confusing. All right, so now let's just throw this stuff into a balance sheet and income statement just to see how it might look if we were putting it this way. And again, I'm going to do this quickly just so we can take a look at the formatting of it. So I'm just going to say, all right, cash, let's just pull this stuff in. We're going to say, all right, let's just pull this in and say cash. That's straightforward. We're just pulling this in from the consolidation worksheet. Nothing's in the investment. I should just delete this account altogether. And then we've got land, and we've got building. Nothing new, strange, or unusual here. So we'll just sum this up. Summing this up. There's our assets. All right. Then we'll take the liabilities. I'm going to say negative of, not there though, not there, here. Negative of this one, negative of that one. Let's indent this a bit because it should be indented. And then I'm going to sum those up. Here's our liabilities. And then the equity. Here's where new stuff happens. Here's where stuff's going to happen that's new. So we're going to say the common stock is going to be this one. Retained earnings. Now, this is something we typically get from the statement of retained earnings, but we can do it here now because we have a beautifully formatted trial balance over here. So we could say, all right, retained earnings is going to be like all of this stuff. So everything below here. Now we're going to break this one out separate. So this new thing is it's gonna be a little bit tricky here. But normally retained earnings is the negative sum, because the credits are winning. I want debits over here of everything from retained earnings on down. Everything from retained earnings on down, except for the fact that I want to break this item out separately. So this item needs to be broken out separately. I want that down here. So I can do it this way. I can say, except that I want to break this one item out. So I'm going to say, all right, let's take this item out. And so retained earnings is really going to be all of that stuff minus this one that we're going to break out separately. Or in other words, retained earnings is going to be this plus this. And again, credits are winning. So this minus the credit minus the debit. And then plus the credit minus the debits. So the 632.8, the 632.8. So everything except that non-controlling interest in net assets of S, which we are breaking out separately. So we can build the balance sheet here. So then if we sum that up, we're going to say equals the sum of these items. And of course, the new thing here being this 36,200, the non-controlling interest in the net assets of S. So the non-controlling interest, that's going to be the new thing. Notice once again, balance sheet is all consolidated together. Every account's consolidated together. We're just showing on one line item, in essence, that 10% of non-controlling interest. Now let's go on, and if are we in balance here? We're not in balance here. Hold on a second. Oh no, we got to then sum up equals the sum of the liabilities and equity. I was getting worried for no reason. So here's liabilities and equity equaling the assets. All right, so we're good there. Everything looks good. Now let's go to the income statement. So here's the new thing on the balance sheet. Let's go to the income statement. So I'm going to hide this. I'm going to go from column O to column R. So I'm going to put my cursor on column O, select over to column R. So we're going to OR, the columns OR, O-R, O to R, and then right-clicking the selected area, and we're going to hide them. Then we're going to create the income statement, which, okay, I'm going to do this pretty quick because, like I say, most of it's going to be the same stuff here. So I'm going to say the sales in, I'm in column U, I'm going to be in the outer column. I'm going to say negative to flip the sign, and I'm just going to pick up the revenue. So we're going to pick up the revenue, and then I'm going to go down to the expenses. I'm going to put them into the inner column. I'm going to pick up the cost of goods sold. So scrolling down to the cost of goods sold, we'll pick up that number. Then we're going to go to the depreciation and do the same thing. We'll pick up the depreciation. And then I'm going to go to other expenses and pick that up. What we're not going to pick up, I'm going to pick up as a subtotal this the non-controlling interest. So I'm going to say, okay, because the non-controlling interest is basically acting like an expense. So you could put it in the expense, but let's see how this will work. I'm going to sum this up equals the sum. I'm going to bring this over in the outer column, and then we'll subtract this out. Now this is going to be equal to the sales minus the expenses not including that non-controlling interest. Now, so that's going to be the consolidated net income. In other words, it's the net income not including this non-controlling interest. So it would be the revenue minus the expenses if we hadn't included this thing that's kind of acting like an expense, the non-controlling interest. So we're going to say, all right, and then let's go back up and include that. So we're going to bring out our subcategory, and then we're going to put this into place. We're going to say less or minus the non-controlling interest. And so there we have that. And now that's going to give us, I'm going to do the sum formula, which is going to subtract these two out. The 428 minus that 7,008 gives us the 420,200. So the 420,200 is the 420,200 here. Now I'm just going to do a quick worksheet to get to the retained earnings. So the retained earnings, I'm going to say for the total retained earnings is going to be the beginning retained earnings is going to be that 299.6. Then we had the net income. I'm going to be picking up the net income. I'm going to say is that 420,200 less the dividends. So the dividends I'm going to say is, let's do it a subtraction, that 87,000. That means the ending balance, if we sum this up, then we get to that 632.8. So the 632.8 on the retained earnings, and you'll recall this is going to be this, and then all of this, not including the non-controlling interest. That's the 632.8. If we unhide, I'm going to go from column M, select it, left click on it, and go to S, let go there, right click the selected area and unhide it. Then we're going to see that the equity here, or the retained earnings here, the 632.8 ties into the retained earnings here. And of course, we're picking up the net income, which is basically the consolidated net income. We should probably say the full consolidated net income, the controlling interest here. So I've actually adjusted that now. So now we have the consolidated net income to controlling interest is here, and then the dividends, and that's going to give us our ending balance. One more transaction that we need to enter here, and that was that depreciation transaction. So I'm going to add the last transaction. We've seen it in the past. It's only going to affect these two accounts, and it should pull over to the financials real quick as well. So that has to do with the depreciation. You'll recall that we want to put it on the books at basically book value for company S as of the point of consolidation, which was a year ago. So it was we started at the beginning of the year, and now it's been 1 year later. So how do we know what it was at the beginning of the year? Well, just we happen to know that this was 1 year's time, and therefore this includes what it was at the beginning plus the current year depreciation expense. Current year depreciation expense is 9,000. So the 18,000 minus the 9,000 is 9,000, and that's what it must have been at the beginning. So I'm going to say that this is going to be the accumulated depreciation, and then the building, and the amount is going to be for that 9,000, which is that 18 minus the 9. And then if we were to record this, we're going to say, all right, accumulated depreciation equals the 9,000. So we took this, in essence, this 18,000 for S, and we've reduced it by that 9,000 because we're making it as of the book value as of the beginning of the year, and we're putting it into or reducing the building and machinery. So we've seen that transaction in the past. There it is there. So we adjusted these two accounts. If we used formulas in the balance sheet as I did here, it should just pull over and adjust here, and we should still be in balance in our balance sheet and everything. So hopefully that's not too confusing.